Today's video, the topic is private equity investing basics. I do get asked about this asset class from time to time, so I thought I would take this opportunity and make a little video about the basics around private equity investing. If you are new to my channel, my name is Jared Ayers. I am a CFA charter holder and have created this channel to share the different ways I think about investing, asset classes, thought processes, techniques, and strategies. So before we get into the details around private equity investing, I just want to get some definitions out of the way first, just in case there's some people that are unfamiliar with this type of investing. So private equity falls under the alternative investments asset class. In its most basic form, private equity funds basically raise capital from accredited or institutional investors and then put that money to work buying and growing companies in the private markets with a view to eventually exit those companies or sell those companies at some point in the future for a tremendous profit. So why private companies? Basically the thought process, and often what is actually true, is that private companies can be bought for a significant discount, all else being equal, to their publicly traded cousins, mainly just because there's not really a ready market for private companies. It's generally one-to-one negotiations between buyer and seller, as opposed to a broad market like the stock market where everyone can see what's going on and information flows freely and publicly to anyone who wants it. So that's the basic idea behind private equity and what it does. So in terms of how private equity funds are structured, traditionally they are set up as a partnership. The partnership consists of a general partner and a number of limited partners, those limited partners being the accredited investors or institutional investors. The general partner's job is to take the capital from the limited partners and invest it over a period, usually around 10 years or so. And then at the end of that period, return a significantly larger amount of money than the limited partners originally invested in the fund. Of course, that's always the end goal. For their work, the general partner receives a 2%, well, generally 2%, could be 1% depending on the fund, but traditionally 2% fee for all assets under management. So the initial amount raised as part of the fund, and then a 20% take for returns generated by the investments that the general partner makes. So that's traditionally known as sort of the rule of 2 and 20 in the private equity world. So in my view, I kind of classify private equity funds into two broad categories. The first category is publicly traded private equity funds, and the second category is privately held private equity funds. Now that last one may seem a little bit redundant, but I'll explain in a little bit what I mean by these distinctions. So further breaking down the publicly traded private equity funds, there are really two, I guess, categories I think about when I think about the publicly traded funds. The first group is those private equity funds that identify as private equity funds but happen to be publicly listed. And the second group would be in the group I like to call private equity-like companies. So they don't necessarily identify as private equity funds, but the way they operate looks a lot like private equity funds in terms of how they behave and what they actually do to generate revenues. So, examples, I guess, of the publicly listed private equity funds that identify as private equity funds. So you've got KKR, Blackstone Group, Apollo, and Carlyle. Those are probably the four largest, and I'll include all of this in the description as well, with tickers and everything, so you can go look at these companies at your leisure. Examples of the private equity-like companies, so those that don't necessarily identify as private equity funds would include things like Berkshire Hathaway, Brookfield Business Partners, Constellation Software, and Fairfax Financial. So those companies, I'll explain a little bit how they differ. So the publicly listed private equity funds that identify as private equity funds, as an external investor, what you are basically investing in is sort of the general partner's returns. So the fund itself may actually have a number of different vehicles, a number of different funds, a number of different products even. So it's not necessarily all pure private equity as I've explained it. It could be hedge funds, could be a whole bunch of things. But basically these funds are set up, they have general partners running each of them for these larger private equity funds. And as an external investor, you're basically getting that 2 in 20. So the fund itself is getting its management fee from the total assets under management, plus every time the fund divests something, that GP is getting their 20%, which translates to the firm or fund's total returns. And as an external owner of that fund, then that's effectively what you're investing in. So plus there's probably a little bit that the general partner has to invest in their funds themselves to show that they have sort of skin in the game. So any returns they're receiving from those investments also flow back to the external shareholders of the publicly listed private equity fund. On the flip side, with the private equity-like funds, those companies don't operate the same way. So they're not buying, holding, and then selling the businesses in their portfolio. Oftentimes they are buying and holding the businesses in their portfolio, still purchased from the private markets often, or maybe they've taken a public company private or something like that. Berkshire Hathaway obviously has done that using the float from its insurance businesses, as has Fairfax. And the other two, Constellation Software and Brookfield Business Partners, they are serial acquirers. Brookfield obviously a major player in the real estate space, but Business Partners is their sort of private equity-like arm. But again, they're not set up as a 2 in 20 fund with a GP. They are just buying with their own resources, their own cash flows, etc., and generally holding those companies until they either are ready to sell them, or maybe they just sit in their portfolio and generate income for their shareholders. So that's kind of my take on sort of the private equity opportunities in the public markets. So in terms of privately held private equity funds, I use that term specifically because these types of funds are really only for accredited investors. You can look up what the term accredited investor means if you want. So they're not opportunities that most people have the opportunity to get into. They're reserved for sort of the high net worth individuals or institutions out there. So the two main kinds, just for information, are really the leveraged buyout private equity firms or the venture capital private equity firms. Leveraged buyout private equity firms are firms that go after companies that generally have very low debt but very high cash flow. What these companies will, or what these funds will do, is go in, acquire these companies using a very, very large amount of debt. So their equity interest they have to put in is very low. What they then do is use the company's excess cash flow to pay down that debt and effectively generate a massive amount of equity for themselves in these companies. So when they do go to sell them, they basically own nearly 100% of the company as equity holders. So they basically create a tremendous amount of value for their funds and their shareholders. So on the flip side, venture capital funds, these funds, as I'm sure many out there are aware, invest in very early stage companies or even startups. companies that have grown through the venture capital streams. There's many out there that people will know, obviously, especially in the social media space. Facebook, Twitter. There's other companies, GoPro, Airbnb, Uber. All these companies basically were discovered by venture capital firms very, very early on, and basically, GPs that are really, really talented at spotting, the next big thing, can do very, very, very well for their shareholders and their limited partners through venture capital investments. Obviously, these companies start out very, very tiny, and they can grow to obviously multi-billion dollar public companies. At least that's often the goal of the venture capital firm, for sure. So again, these are the types of privately held private equity firms. Not for everybody, but these I think really give the best opportunity for diversification if you're thinking about private equity as an asset class. So unfortunately, if you are not an accredited investor, obviously you are limited to the publicly traded private equity funds or private equity like companies, or even also there are ETFs that do hold baskets of publicly traded private equity funds. So those are all opportunities. Now, like I said before, with publicly traded REITs, it's interesting to look at these publicly traded companies, but if you want to think about diversification, oftentimes you will get the diversification if you go and invest in these types of funds that are publicly traded, but oftentimes when you do need that diversification is when markets tend to go south, and it's usually at that point that the investments in the publicly traded funds end up acting a lot like the rest of the equities out there and do not provide any kind of diversification in terms of correlation differences to the rest of the broad market. So do keep that in mind. Obviously, the benefit of private equity is that they do find mispriced assets in the private markets. That's their goal, and that's how they create value. Is they do basically make their money when they make their purchases, and then do what's necessary to grow those assets with a view to selling them ultimately. So sometimes after a downturn, it may be an interesting space to look at because again, those private equity funds may themselves, because they got taken down with everything else, be mispriced in the public market. So that is something to consider as well. So I hope you found this video useful. Maybe you got something out of it, or maybe you learned a thing or two. Again, this is kind of my own take on the basics of private equity investing. There's a lot more to it than this, and certainly this covers a very narrow range. And people may say, well, there's a lot more to it. There's hedge fund investing and all that kind of stuff. But to me, those are slight offshoots of what I view as traditional private equity. So take it as it is. If you do like the video, please give me a thumbs up. If you are not yet a subscriber, want to see similar content, my own views on other asset classes or different ways I invest and think about investing, then by all means hit the subscribe button. And if you want to leave any comments below, questions, or your own thoughts on this asset class or anything else you've seen in my other videos, then by all means, please feel free to leave comments. Until next time, thank you very much for watching.